What's up, guys? Unibi from Silent Peeps FX Academy, and I have another interesting one today, the trading plan. Now, for those of you who don't know, we have a customized course which was made to take absolute beginners from level 0 up to the point where they'll trade the foreign exchange market and make profits. So we have a 30 days course, and today we're going to be talking about day 5 of the course, which is titled Trading Plan. And this is the only thing that matters. So if you want to trade profitably and make some profits from the market, then this is a much watched video for you. So stay to the end while we talk about trading plan. Okay, now we're going to talk about what it entails. We talk of class of assets, correlation, and all of this. Before going through this video, or this video is actually meant for people who have the basic knowledge on what foreign exchange is, people who have probably placed a couple of trades on their own, or even experts who still have issues, experts who have been trading but have issues of making profit consistently. So we're going to just run through all of this, and at the end of the video I'll dive in to show you how to actually practice some of these things. Now, talking about equity in foreign exchange is the sum of the trading account balance and all the floating open positions. So if you have an account size of $100, for instance, and you're currently having a plus $10 on your running trades, then your equity is $100 plus this $10, that is $110. Now, the pip difference, this comes into play when we start talking about your stop loss, your take profit, how many pips is your stop loss, how many pips is your take profit, and so on and so forth. So it's very important for you to master, to be able to calculate all of this and be flexible with it. The lot size. Now, most of the times when they talk about your plan, risk management, and all of this is controlled by the lot size, because it actually determines how much you're going to make per pip, or how much you're going to make generally in the market. Now, let's talk about the first aspect, what you should have in mind when it comes to setting a good trading plan, which is choosing your class of assets. Now, beginners, when they start their career in trading, often find it difficult. What do I get to trade? There are a couple of currency pairs, there are a couple of indexes, and all of these that people might want to trade, commodities, stocks, and so on and so forth, until you get you find it difficult to select which you need to choose. This is the first. Now, the key is don't take more than three pairs to trade. I for one, I trade just like two pairs, and I'm actually good because I've been testing them for a while, over and over and over again, and these pairs work for me. So you must not trade all the pair there is. Select two in each class of asset. Maybe in currencies, you can select two currencies you're going to be working with. You go to stocks, you select a stock or two, or whatsoever the case, but narrow it down as much as possible. The smaller it is, the better for you, because it's going to be easier for you to back test, easy for you to practice more and more, and even build a strategy that is channeled to one particular class of asset best suited for you. Now, when you want to choose your class of asset, you should have this in mind: risk diversification. For instance, if you choose Euro USD and Euro Australian dollar to be two currencies that you're going to be trading primarily, it's not really good. It is bad. And it's bad because, for instance, if euro is causing a move in the market and you enter two trades and you're losing on euro, then definitely you're going to lose on euro Australian dollar as well. So risk diversification is if you take something like euro US dollar and the pound Japanese yen. Now, these two are not actually dependent on each other. So if you're making profit in euro USD, you're not necessarily or if you're making losses in euro USD, does not affect the pound yen. Have that in mind, as well as have correlation in mind. Now, what is correlation? Is a statistical term that describes the degree in which two currencies, in this case, are related to each other. Now, take a look at this. We have two currencies here. We have the pound USD and the euro pound. Now, these two currencies are said to be in negative correlation. If you see my cursor up here, you notice that anytime pound USD is moving towards the downside, what is happening? Euro pound is moving towards the upside, and it's some sort of a mirror effect. When pound is going up, pound USD, euro pound is going down, and so on and so forth. Now, should in case you have two currency pairs that are positively correlated and you're going long in one and going short in the other, then there is a problem with your analysis. So have that in mind. We have a guide here that displays correlation. So correlation is measured as negative and positive. So -1 to show that these two particular currencies are 100% negatively correlated. So each time one of them is buying, the other is going to sell. And also have +1 and all of that, which is 100% positive correlation. So if we look at this table, Australian dollar is positively correlated to Euro CHF, but only 0.5, and that's just about 50% positive correlation. This one, Australian dollar, is also negatively correlated to euro pound, of which this is 0.04, and this is a very strong relationship, very close to 0.1, or very close to -1 rather. It's a very strong relationship. So most of the times when euro pound is moving towards the upside, then we'll have Australian USD moving towards the downside. Negative correlation. Have this in mind. You can always have this chart to refer back. This is again just for the purpose of correlation. These values are just for the purpose of correlation study. Okay, so you can have this in mind to guide you whenever you want to place a trade. So should in case two particular currencies are correlating and you have diverse analysis, then you should check your analysis again. There is a problem somewhere. Now, moving on, let's talk about this very most important thing, which is the risk to reward ratio. Now, if you are a trader and you use very good risk to reward ratio most of the times, then statistically increases the probability for you to be profitable over time. Should in case you have 1:1 risk to reward ratio, that is, if you're risking $10 per trade, you're risking $10 to make $10. Now you need a win rate of at least 51%, meaning that if you enter 100 trades, 51 times you should actually have winning trades. 51 times your trade should hit your take profit and all of that. But if you come down and use the recommended risk to reward ratio I have here, which is 1:3, you see, even if your analysis is as bad as you get to win only 26 out of 100 times, like in this case, you still get to be profitable. You are still profitable, and so on. So risk to reward ratio is good. How do you even go about this? You need to calculate how many pips your stop loss is, how many pips your take profit is, and you take the ratio to know your risk to reward ratio even before you enter the market itself to place a trade. Now, it is very important to trust your analysis. Trust your analysis as a trader. If you've taken time to learn the principles of trading, when this happens, you expect the market to move towards this direction. Now, many people always have problems is because they have an initial bias of the market position. After that, they change their mind and then close potential trades that could have given them profits just because of maybe a wick that is forming against them or whatsoever. And and later on what happens? Almost all the time it moves towards your direction. In fact, most of the time, out of experience, out of what other traders have around me have experienced too, when I always call or when I ask them about it, most of the times when they close their trades before it gets to your stop loss, what happens? It moves back towards their direction and hits their take profit and all of that. Trust your analysis. It is very important as a trader to build your self confidence. Yes, you're going to lose trades. Yes, you're going to win some trades as well. But whatever the case, if you have your risk to reward ratio and if you have other aspects of your plan straight, then there is no need for you to be scared for if a trade hits your stop loss. There are two possibilities when you enter a trade. Either it hits your stop loss or it hits your take profit. That is why you must even be technical about setting this stop loss and take profits. Technical about your risk to reward ratio. In fact, you need to do a bunch of calculations before you enter the trade so that whatever the case, even if the market is hitting your stop loss, you are contented, you are protected, and so on and so forth. You take another trade and everything is fine. Your psychology is not messed up. Always make sure that you have a daily target. Very important. And your daily target should not be measured by the number of US dollars you make per trade, for instance, or the number of pips you get. Set a daily target that is flexible to different environmental situations. Should in case you're trading $100 account, okay, then something happens, you're trading, the account goes down to a $75 account. Your daily target is supposed to be flexible, so it is best not to even set pips as daily targets, but to set percentages. Most of the times you can say, okay, I'm going to make 0.5% a day, 0.2% a day, whatsoever your daily target is. Now 0.5% of a $100 account is it's $0.5. That is actually a good daily target that you can set and stick to. Okay, if you're making 1% a day, then you're making $1 on a $100 account a day. That is a good target. Once you've hit your target, you stay out of the market. You wait for the next day, you enter your trade, and you also need to have a daily loss. Personally, now, if it is a bad day and it happens that all of your trades are hitting stop loss and whatsoever, you should have a limit. This day I don't lose more than 1%. I don't lose more than 0.5%. This is going to reflect in your trading plan. Set all of this and set it based on percentages and not based on the US dollar or the profit amount or the number of pips and all of that. Now, one other most important thing is to set your criteria for entry. Now, based on the type of trader you are, if you're a scalper, a day trader, a swing, whatsoever, the way you analyze the market matters to you. And what is most importance is your entry. What do you need to see before you enter a market? If you're trading with indicators, then you should have probably set up your criteria for entry, that if you're trading with MACD, for instance, this should happen before you enter the trade. If you're trading moving averages, this should happen. All of this, you've written it down within your trading plan, okay? And make sure that you follow it. Now, if you're trading with charts or if you're trading naked charts and you look at chart patterns, candlestick patterns and all of that, then you set your criteria for entry. And while doing this, have a duration in mind. How long am I willing to sit in for this trade? Most of the times I don't like to sit in for a trade for too long. I always like to get into a trade and get over with it and get into another one. So I'm more of a day trader. and all of that. Because of that, I'm not going to go into a 1 day time frame and place a trade or look for an entry in a 1 day time. No, because I don't expect to spend up to a day within a trade and all of that. So the duration, you should have a duration. So how long do you intend to stay in this trade? Most of the times, volatility of the market helps you. You can use other indicators like the average true range that tells you the average price movement or whatsoever. You can calculate it manually too, and you can just even be able to see it with experience at some point. You should also take note of entries. Sometimes traders are fond of this, especially newbies. You come into the market, and because you've seen a spike towards the upside, you hurriedly go into the market and place a buy. You're trying to follow the market, and that is very bad. Most of the times what happens, there's a quick rejection. So you want to enter at the best possible place or best possible point. And where is this? This is a point in the market where you have the tightest stop loss. Okay, so most of the times the best entries are always after a retracement. After a retracement has just occurred, you enter. How do you spot that out from your analysis? Okay, we're not going to look into that. And then lastly, risk to reward. Again, risk to reward, you should have in mind risk to reward is going to, this is supposed to be risk to reward slash the lot size you're using for a trade. And that is what I'm going to indicate practically for us to see on a chart how we should go about this. Now, you should state within your trading plan that you're not going to enter the market with a risk to reward, for instance, less than 1:3. And how do you even know? Most of the times for newbies, again, you just enter the market and you just say, okay, my risk to reward is 1:3. In this case, I want my stop loss to be maybe 10 pips. Then 1:3, my take profit should be 30 pips and all of that. That is not the case. The market tells you where your stop loss is supposed to be. The market tells you where your take profit is supposed to be as well. And if the market shows all of these and you see that it does not align with 1:3 and your plan, and based on your trading plan you have a minimum risk to reward of 1:3, then you don't stick that trade. You don't stick the trade. That is it. Your stop loss, take profit is indicated within your chart and all of this. Now, these are the main things. These are some of the things you should have in mind. This course is just to guide you through the process, and we're going to be looking at a real example. And again, trading or creating a trading plan is easy. It is not the problem. The problem is following this plan. Okay, following it could be tricky because most of the times you set your own goals and then you turn on breaking it, but that leads to inconsistencies. And if you cannot be consistent with making profit, then you're not going to be overall profitable. You make money today, you lose it tomorrow, and so on and so forth. The goal to trading is consistency. Now that we have the trading plan out of the way, let's go now within the charts, and I'm going to show you some basic two things: how to spot your stop loss and your take profit in the charts, and as well how to know the lot size to use based on your risk to reward ratio. Coming back to the charts, I have euro US dollar here, and let's do a quick analysis to get an idea of the market, and we go ahead to practice how to select or how to set our stop loss, take profit, risk to reward ratio, and see the choice of lot size we use. Okay, I'll first start by identifying key points. Looking at my chart, you see they are actually zooming very well so that I can see as much of the screen as possible. I can identify a support at this point, as well as I can identify yet a resistance at this point. Clicking just as I hover, I can also identify a key point here at this level. So now this is the basics of price action. Market is going to move to where it was at some point in time previously and all of that. So now that I've established this already, I'm going to go ahead and open my chart and let's take a look at it. Now we're going to be doing an assumption that even if I don't know how to trade and I'm placing a buy and a sell, let's look at how setting a good plan will actually go a long way to ensure that you are in profit. Remember, like if you have a good risk reward ratio, you just need to be in profit 26% of the time and then you are good to go. Now these are the points that I've spotted out, and I'm going to look at two cases. I'm going to look at the case where we are to go on a long, and I'm going to look at the case where we're to go on a short. So again, like I said, your stop loss and take profit is not actually, you don't guess that. The market tells you where you should put your stop loss and your take profit, and most of the times it is best to put it below or above particular points, support points, resistance points within the trade. Now should in case I'm supposed to go long in this trade, this is my long position and then I'm going long like right now. I have a bias that the price is going to move up right now and all of that. I'm entering a long position, then my stop loss is supposed to be below the support, below the previous support. So this is a previous support. The previous support is exactly at this point here, and then it's always good to go below to give some space, some breathing space and all of that. Now if we go below to this point, we have a risk reward ratio of 1 is to 2.3. 1 is to 2.3. So this means that if the price moves up to this direction, we're going to be making a profit. We're going to be making 2.3 times the profit if price was actually moving down to take us to hit our stop loss. Let me do a quick calculation from here using the ruler tool. From here to here, we have 21 pips, a take profit of 20 pips, and then 22 pips actually, and then we have a stop loss of 9 pips and all of that. Now let's assume that you're trading a $100 account. Because you're trading a $100 account and you've done your analysis, and based on your plan you can take a risk to reward ratio of 1 is to 2, and you've done your analysis and you've seen that your stop loss is 9.4 pips. Let me just multiply it to 10 pips, going relatively down below, and we have a stop loss of 10 pips, and you're trading a $100 account and you have, let's say, a profit target of 2% on a daily basis, and you have loss, you can make a maximum loss of 1% on a daily basis too, and based on your plan too. For instance, you might have said your plan that you can take trades with risk of reward ratios greater than 1 is to 2. Now if that is your plan, then this is a trade that you can take. Now taking this type of trade is okay because it's based on your plan. Now the next thing is, what lot size do you take for this trade? Now you want to look for a lot size that if you hit 10 pips, it's not going to take you more than $1, since that is the maximum. That's the maximum that you want to lose for a day. That's the risk that you've set. You cannot lose more than $1 a day, which is 1% of your account, and you're willing to actually make 2% of your account. So if this trade actually moves towards the upside and hit your take profit, then you've made 2% and you're set for the day. Now the lot size, the ideal lot size to use in this case here, it's the lot size of 0.01. And why is that? Because we know that for a USD based account, a lot size of 0.01, 10 pips is going to give you exactly $1. And that is how you need to know. Calculate the number of pips calculate the amount you're willing to lose, and with these two things it's going to tell you the lot size that you use per trade. Now let's take another random example. Should, in case you have a $500 account and the plan is still the same, you don't want to lose more than 1% a day. What is 1% of $500? That is 5. So which lot size can you use to ensure that if the prices move against you and hit your stop loss of 10 pips, you want to calculate the corresponding lot size that is going to prevent you from losing more than $5. If you still have a stop loss of 10 pips, then you cannot use more than a lot size of 0.05, because 0.05, if it hits 10 pips, then that is $5, which is 1% of 500, and which is just the amount of money that you want to lose per trade. You should always have that in mind. Now let's look at another example. Let's say, should, in case you've done your analysis and then you rather have a sell bias. I'm just going to delete this and then let's put in a sell bias. Again, like I said, you don't choose where your stop loss or your take profit is. The market tells you the next possible or the next point. So if you're entering a sell in this case, then your take profit should be at this level and your stop loss should be at the next point at this level here. So you're having a risk to reward ratio of 1:0.2. So whatever the case, you're losing. These are the type of trades you are not supposed to take. These are the type of trades you are not supposed to take. So take only trades within the given risk to reward ratio allocated in your trading plan. I guess with that, we should have gotten some understanding. Subsequently, when we have live analysis or further videos, then you should understand very well. Now, meanwhile, if you have any questions or clarifications, feel free to leave a comment and I will be happy to help you out. Thank you for watching this video to the end. I would like to actually see you become profitable at the end of the day in your foreign exchange career. Feel free to leave a like, subscribe if you've not subscribed to our channel before, and I'll see you again in the next video. Ciao.